Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Advantage Solutions Inc. quarterly report. Advantage Solutions Inc. offers a wide range of services to consumer packaged goods manufacturers and retailers across North America, Asia Pacific, and Europe. Their branded services segment provides sales, merchandising, and marketing support to branded manufacturers through brokerage services, branded merchandising, and shopper-centric marketing programs. In addition to these services, Advantage Solutions also offers experiential services that include in-store and digital sampling programs, demonstrations, and experiential events designed to drive trial and conversion. These experiences are tailored to engage consumers and promote brand awareness. The company's retailer services segment provides solutions to support retailers in various areas such as in-store merchandising execution, private brand strategy development, retail media, and marketing initiatives. This includes reset services, category updates, space management, audits, retailer merchandising, advisory services, and agency services for print and digital circulars and targeted advertising. Overall, Advantage Solutions Inc. offers a comprehensive suite of services that cater to the needs of both consumer packaged goods manufacturers and retailers across various channels in retail locations. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance. On the positive side, the experiential services segment experienced significant growth, with a revenue increase of $71.5 million, representing a 22.8% growth rate. This was also reflected in the total company revenue, which rose to $869,601,000 from $821,792,000 in 2025. In contrast, certain segments saw a decline in revenue. The branded merchandising services and omnicommerce marketing services experienced significant drops of $30.6 million and $26.5 million, respectively. These declines were likely due to changes in consumer behavior or market trends. The company's working capital also played a crucial role in its financial performance. Favorable movements in working capital resulted in an increase of $63.4 million, driven by increased collections of accounts receivable on higher sales and a decrease in accrued interest payable due to timing of interest payments. Overall, the company's revenue growth was driven primarily by the experiential services segment, while certain segments experienced declines. The net income of the company experienced a significant decline from $56,130 in 2025 to $71,831 in 2026. This decrease can be attributed to various factors. One major reason is the divestiture of European joint venture and Jun Group business, which likely resulted in a one-time loss that negatively impacted net income. On the other hand, operating income saw a substantial increase from $14,621 in 2025 to $4,162 in 2026. This improvement can be attributed to higher revenues in certain segments, such as experiential services and retailer services, which were partially offset by lower restructuring and stock-based compensation expenses. Profit margins also showed an upward trend. The gross profit margin improved from 12.1% in 2025 to 12.3% in 2026, while the operating profit margin increased from -1.8% in 2025 to 0.48% in 2026. These improvements can be attributed to a combination of factors, including lower operating costs and higher revenues in certain segments. The changes in net income and profit margins are also influenced by the Accounting Standard Update, ASU 2025-6, which is being evaluated but not yet effective. This update may have an impact on future financial reporting, but its effect on current results is minimal. Overall, the company's financial performance shows a mixed picture, with some segments experiencing growth while others face challenges. The company is experiencing a significant improvement in its financial performance, as evident from the positive operating cash flow generated during the 3 months ended March 31, 2026. According to the financial statements, the net cash provided by operating activities was $23,728 indicating a substantial increase in the company's ability to generate cash from its core operations. This positive trend is further confirmed on page 29 of the report, where it is explicitly stated that operating cash flow, positive $23,728,000. This suggests that the company has successfully managed its working capital and operating expenses, resulting in a significant increase in cash generation. Overall, this development bodes well for the company's future financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the debt level increased by $1.035 billion due to a new term loan facility in 2026. However, this was followed by a decrease from $438 million under the previous revolving credit facility to $385.8 million under the 2030 ABL in 2025-2026. The interest expenses also saw significant changes, particularly with the introduction of senior secured notes with higher interest rates and payment-in-kind fees recorded as debt discounts in 2026. This led to a substantial increase in interest expenses compared to the previous year. Furthermore, there was a notable gain of $0.3 million in interest expenses in 2026, contrasting with a loss of $1.6 million in 2025. In contrast, some sections indicate that there were no significant changes in debt level or interest expenses between 2025 and 2026. However, these instances are limited to specific pages and do not reflect the overall trend. Overall, the data suggests that the company's debt level and interest expenses have undergone substantial changes over the past year, with some fluctuations but a general upward trend. The company's performance can be analyzed through its various segments and regions. On the positive side, experiential services have been a standout performer, with significant increases in revenue and operating income. The segment saw a substantial jump of $71.5 million, representing a 22.8% increase from the previous year. This growth is even more impressive when considering that operating income rose by an astonishing 428.2%. Another segment that has shown improvement is retailer services. Although the growth rate was not as high as experiential services, it still managed to increase revenue by $9.2 million and operating income by 107.5%. This indicates a steady and consistent performance from this segment. On the other hand, branded services have been struggling. While brokerage services saw an uptick in revenue, merchandising services and omnicommerce marketing services experienced declines. The segment as a whole suffered a significant decrease of $32.8 million, representing an 11.3% drop. Furthermore, operating losses increased by 4.8%, highlighting the need for improvement in this area. Overall, these results suggest that experiential services and retailer services are driving growth for the company, while branded services require attention to reverse their decline. Their management is optimistic about the company's outlook, citing strong performance in its experiential services segment due to sustained client demand and effective execution. However, they acknowledge that the branded services segment has been impacted by macroeconomic headwinds and client losses. Despite these challenges, management highlights significant progress made in reducing costs and improving operational efficiency. The company is also focused on integrating and restructuring its business to align with revenue levels associated with recent changes. Management expresses confidence in the company's financial position, stating that cash on hand, cash flows from operations, and available credit facilities will be sufficient to meet working capital requirements for the foreseeable future. They expect existing domestic cash and cash flows from operations to fund operating activities and commitments for at least the next 12 months and beyond. The company's financial strategy reveals a focus on growth over shareholder returns. A review of their recent activities shows that they have not paid out any dividends to shareholders, indicating a preference for reinvesting profits within the business. Furthermore, there has been no share buyback program initiated by the company, suggesting that they are prioritizing expansion and investment in new opportunities rather than rewarding existing investors through capital returns. That concludes the financial summary for Advantage Solutions Inc. Feel free to comment below, and I will be happy to answer them when possible.